In this video, we are going to go through how to set up a policy properly if you are interested in finance and high cash value life insurance. Earlier this year, I received a phone call from an individual who earns about $600,000 per year. He is employed by one of the largest insurance companies and financial services providers in the world, the second largest in the world actually. They are a publicly traded company. And this individual has actually written the script for a lot of their sales force as far as how to conduct themselves when engaging with clients, prospects. He knows his stuff. He's very sharp. Now, he is interested. Why he made the phone call is he's interested in a whole life insurance policy, but he is in the business. His company primarily sells variable universal life insurance. They actually don't even offer whole life insurance, but he used to work for companies that did offer whole life insurance, some of the major mutual companies, and he knows the product inside out. Like, he knows what to look for. His interest is maximum cash value. He knows what questions to ask. He's interviewing me, but as I'm talking to him, he is very clear on the phone. He speaks extremely clear, enunciates his words perfectly. I have not asked him if he's worked on his personal development and presentation, but man, he's at that level. Like, when you talk to people and you're like, this guy's good. Like, that's the reaction I got over the phone. At first, I'm like, is he like acting? Is he an agent trying to get information from me? Because he was like so good, I thought he was over exaggerating. Then I'm like, no, he knows his stuff. Okay, Steve, get on your game when I'm talking to him. But I'm not going to tell the entire story here. What he was interested in as I'm talking to him was really two things. He was working with other agents, had actually started the underwriting process with different companies. But what he mentioned to me, the first thing that really jumped out at him was the company selection. Because again, he knows cash value life insurance. We always talk about what do the wealthy do, what do people with money do when it comes to these policies. We want to copy that model. They know it. He knew it beyond just knowing it and seeing what the wealthy does. He actually sells it. His company deals with private placement insurance. Like, he knows how these products perform. He's got a better feel on them than most. But company selection. When he engaged with the other company, and I remember this because he told me this and it's just stuck with me. He said that this other company said to him, hey, we recommend a smaller life insurance company. It was a mutual company, but we recommend them. This is who we prefer. Specifically, here's what he said. There is no way I am going to flow $2 to $3 million of my cash through that small company. There's no way. Now, why would he say this? He knows the industry inside out. And again, I'm educating him, going through our normal process, but I'm talking to him. You ever go through, a Q&A session and you're answering questions, you're providing information to someone, and they know the answer. They're just seeing how you answer it to make sure you know your stuff. Like, that's the sense I always get when I talk to him, because he's a sharp guy. He knows the stuff. But he was pitched on a smaller company and he stopped it immediately. There is no way I'm going to flow this amount of money through a small company. There's no proof of performance. They pay very high commissions and I don't see my capital there. Like, I'm not doing it. As I'm having a conversation with him, he makes this statement. He goes, Steve, I want a top mutual company. No. I want the best mutual company for my money to go into a policy. This is for my cash value and also from a death benefit perspective when it comes to legacy planning, leaving a large death benefit to the next generation, creating perpetual wealth, and just constantly repeat that process from one generation to the next. This is what he wanted to do. He knows the industry. We go through our normal process, but I want the best mutual company. Now, who's the best? Well, there's no one company that is simply the best. If there was, that is the company that we would use at IBC Global. And when I say best, specifically what I am looking for someone interested in cash value life insurance is one, the quality of the company from a financial standpoint and such, but really quality in terms of whole life insurance policies that have actually delivered solid cash values. North of an internal rate of return of 4% is really what I like to see. when the policy is designed properly. And we've seen 4 companies consistently do that: Mass Mutual, Guardian, New York Life, and Northwestern Mutual, when they're designed properly. Those carriers are also used when it comes to bank-owned life insurance and corporate-owned life insurance. Not all of them with corporate-owned, but bank-owned, yes. So company selection, very important to him. And then really what he did here was an asset transfer. Shifting assets. He was a cash cow, I'm going to refer to him as, has a lot of money in cash that has just constantly compiled. He's got everything on his balance sheet. He showed me his balance sheet. He's got it all in Excel. It's beautiful as far as how he budgets his cash flow, money for lifestyle, money for savings, deferred comp plans, everything he's doing, he's got it all budgeted beautifully. And we were actually able to map out, here's your current path based on just your overall retirement plan, and then here's what it will look like once this policy is incorporated into your plan, because we're going to shift money from cash over into a high cash value life insurance policy. Here's the thing. The other group, once he said there's no way I'm flowing this amount of money through a small company, the other group was smart in the sense that they pivoted and said, here's one of the top companies, and they showed him that. The issue was when you look at the design, he wanted to do what? Shift or move a bunch of cash into a high cash value life insurance policy. This is his plan. When he saw the other option, he said, that's all right. It's not a 1090 though. It's not maximized based on the insurance company limits and IRS limits. He looked at that and it wasn't a fit. As he studied more, dug into the guaranteed values were very important to someone, which says a lot for someone in the industry. Think of it from that perspective, right? It's way different if we see marketing, we read books, we hear information, versus someone who is actually in that driver's seat every single day. He is 55, he may be 56 now. He's been in the industry for a long time. I've been in it for 10 years now. He's been in it much longer than I have been. But he's in the driver's seat every single day, knows the feel from experience, and he's looking at the guarantees. And he looked at different policy designs, and he preferred, as most people do, I found, that 1090 split, really because of this. He looked at it and said, hey, right now this gives me the greatest cash value based on a guaranteed and non-guaranteed basis. He's heard talk that if you take less up front, you could have more long term. And he said, you're asking me to give up what's guaranteed for something that could potentially come true in the future. But it never has. No, I'm not doing that. Max out the policy to the greatest degree. Now, he didn't say it to us because we always max the policy out to the greatest degree. And if anyone wants to see different splits, we show them different splits. Some people have selected higher splits. It's really up to the consumer, not up to us. But again, someone in the driver's seat, they've got the feel, right? Interesting story, right? So you've got someone very experienced at that level, right? We admire him as a company. I do a lot. I've learned a lot from him just, in regular conversations. But let's see what he actually did. So he took, again, cash. He had a ton of cash sitting there, and it just continued to pile up because he's a net saver. Makes a lot of money, but he saves it. He spends what he needs to spend. They've got a comfortable lifestyle, but he's saving more than what he's spending. So what we've got here, one policy. He received, by the way, a standard non-smoker rating. So this particular option represents a non-smoker rated policy, not preferred, ultra preferred, nothing like that, which is always good to see if you'd like to see different options, or if you're thinking, hey, if I'm not that healthy, but I can get a non-smoker rating, what would it look like? Here's a large policy with that with that rating intact. So 2 options he wanted to see. This is the same policy here. On the left, $400K per year for 4 years. I'm going to add something here. Flexibility was very important to him. His minimum commitment is about $40,000. Touch more than that with a term insurance rider. His premium is about $36,000. Whatever his base premium is, he can 10x that in PUAs, so the true split would be about a 991, something like that. But we maximized it as much as we could. MEC limit, $400K based on that death benefit. Look at the first year. 400,000 goes in, $351,000 in cash value. What is the worst part about a whole life insurance policy? What are the drawbacks to this, Steve? He asked that question. Frankly, everyone asks that question. If you are interested in a high cash value life insurance policy, the biggest pain point, the worst part or the drawback is going to be what we just circled right there. That first year cash value. I pay in 400 grand, I see a little over 350. It's a negative return. When we look at the internal rate of return, it's about negative 12%, a touch more when you really break it down. That's what it is when we squeeze the expenses down as much as possible. You can alleviate that with a high early cash value product, but when you look at that over the long haul, if it's a pure high early where the expenses are higher but spread out, that wasn't attractive. And it is for some people, but a lot it's not. But that's the worst part. The best part is every year after that. So if we see an annual internal rate of return of 0.32%, very minimal, year 2, what that means is he paid in 400K and he got back more than 400K year 2. So we see the growth go from 351 to 754. He gets his 400 back plus about another $3,000 on top of it. It's doing what it's supposed to. Each year continues to pay money in. 55-year-old male, breaking even year 4. I think on the guarantees, I got to go back and reference this, the break even was around year 6, 7 at the latest. Minimum guarantees, that was the break even, because it was designed properly. Annual internal rate of return. There it is. Tops out at what? 4.73, above that, 4.78%. Then you've got the average internal rate of return. What's the average over the life of the policy? If that's confusing, think of it this way. What did you earn last year in the S&P 500 in the stock market? I earned 30%. I knocked it out of the park. What did you average over the past 30 years? I produced an average of 7%. Difference between annual, what I earned that year, and then average. We also have the taxable equivalent, which if you're making 600 grand per year, the majority of which is W-2 income, you're going to be in a high tax bracket. So if we've got this 35% tax bracket, what this means is if I am earning, let's just look at this, year 10, an average internal rate of return of about 3.1%, it's in a cash value life insurance policy, which is what? Safe, liquid, and tax-free. What would I need to earn in a taxable account in order to generate that same 3%, a little over 3% without any risk? Just under 5%, 4.74. And as time passes, I'll need to earn more and more, which honestly, a lot of people could do. The people that are attracted to these products, a lot of corporations and banks are, but it's money that they don't plan on investing in the market. It's their safe funds. Hey, better than a bank account. I don't have to think about it. I can park it, let it sit and grow. I've got this monster death benefit from a legacy planning standpoint. Quick side note on that. Why that death benefit drops year 8 is we cut the term rider here and reduce the insurance expenses. And we can keep that up if he wants to. Didn't want to in this example, maximum cash. But again, going back to the other point I was mentioning, people that do this typically look at it as a cash alternative. Safe area to position funds. If I want to access it, borrow against it to invest in real estate perhaps, or my business, I've got access to my capital all the way through. Now, policy loans right now are a bit expensive relative to the earning rate on the policy, so a cash value collateral loan is a great option if I plan on heavily using a policy and I'm pumping a lot of funds in. When I look at the pure interest rate, when I look at it from a pure interest rate standpoint, it's a good option. That's the thing. So, option A and option B is the exact same policy, but what it looks like, oopsie daisy, if he continues to pay in $40,000 per year after year 5, up until age 70, $40K per year. So a lot of times this happens. Someone has a plan to say, hey, I've got 1.6 million, I'm going to move that just from money sitting in cash over to this policy, over to this high cash value life insurance policy. I got a death benefit too, and I've got a positive cash value. But can I keep adding after it? And the answer is yes. In fact, in this policy, he can keep slugging away $400K per year if he wants to. But the model he wanted to see, what's it look like if I just paid close to the minimum, $40,000, a little bit more in this case. What's the growth look like? Well, it looks pretty nice. I pay in 40 that particular year without crunching returns or anything like that. Grows by a gross amount of over 100 grand. Now I paid in 40, so I'm going to back that out, of course, so I can crunch the actual cash growth. I hate the saying, I give you $1, you get 2 back. It's like, no. I give you $1. I get that $1 back that I paid because I paid it in, then I get $1 of interest. So just for transparency there. But here we go, continue to pay money in, and it keeps on growing. Looks good over time. Just an option, standard, non-smoker rating, one of the major mutual companies, which, remember, I want the best, and this is what he did. So if you're considering a policy, if you're looking at $400,000, or if you're looking at $40,000 or $4,000 per year, you can do the same thing. We've got individuals that have policies with a MEC limit of $4,000, a base premium of $400, which is minimal. Now, age and health does play a factor there. If we're older, we might not be able to get a $400 base premium, but we do that and we see something extremely comparable to what we just looked at. The ratios are the same. So I do hope that you got some value out of this one. I had a lot of fun working with this individual. I talk to him on a regular basis because I love learning from him. He's a good guy. If you enjoyed this video, please hit the like button, subscribe for more, and I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.